gainers. Now, Nigeria's headline inflation for July dropped to 11.1% from 11.2% the previous month. Ayodele Akinwumi, head of research at FSDH Merchant Bank, joins me to discuss Nigeria's inflation trends and impact on the equities market. Ayodele, thank you so much. Always a pleasure to have you on the show.
Thank you very much for having me.
So today, or this time, we're at 11.14% from 11.23%. So in line with most analysts' expectations for a continued decline. Let's hear your thoughts on the numbers as they are right now. And could this be the last decline before we begin to see that increase that's been predicted by almost everybody?
Okay, I think the numbers, the inflation figure is actually in line with our forecast at FXTH research. However, we still saw the food price index that is quite high, 1.4 increase, yes, lower than what
there was a slight decrease. Okay.
In the month of June. And again, I mean, the last time I was in this studio, I discussed about the seasonality impact of that. I mean, around between May and July, each year, in the last few years, we've always had high, food prices, and that make the inflation rate to go up. The food index, which of course is quite big in that, overall index, about 51%. Going forward, it appears that we're going to be entering the harvest season from this month. The major drivers of the food index today by the NBS is other tubers, yam, potato, vegetable, and all of those things. They are going to be harvested going forward. So we think that the rate of increase may likely decline. Yes, we still see a number of problems from the food producing regions in the country, which is the lag impact of it on the market.
Do you think we're going to see it now as we enter, as harvesting begins? Are we going to actually see that impact in terms of the volume?
I think we've seen that already, even though we may still see a little bit of that impact going forward, which may likely not allow it to drop as much as it would have dropped if there was no problems there. But then we expect a further decline around the same level.
So actually nothing so significant, because when we read the headlines and we talk so much about the kind of damage that's been done to many of these farms, the farmers, and many farmlands in the middle belt of the food basket of the nation, one gets a sense that when the numbers do come out, we will see that impact coming through. But from what we're seeing so far, it's not so significant. Would you say significant?
Significant to the extent that if you look at the month-on-month increase between January and actually May, we didn't have as much as we've been having since May to date. And so for me, it's significant based on what we have been seeing. But then going forward, like I said, an impact of harvest season may likely moderate some of those impact, and going forward that will make the food index to reduce a little bit, and that will have moderating impact also on that. But then our revised forecast shows that we may not really have, single-digit inflation rate that we earlier expected this year again. So maybe in the region of 11%, which I think is moderate, going forward.
But at what point do you think we will begin to see that increase, that uptick?
Well, it's like we may likely see that around September, around December, because of the fact that a lot of people buy, things in December. So
towards the festive season. So what about other factors like, for instance, the federal government announcing an increase in the allowance or monthly allowance of the NYSC, and what we're saying is that we don't know about the minimum wage, if that, how to what extent that's going to be implemented or even agreed upon, talking about a figure. And of course, just like you said, these festive season that we're going to go into, do you think that those are also, because for the central bank, these are, along with the 2018 budget, we're expecting capital flows to also come out from the budget. And these are the things that the CB and MPC see and talk about inflationary threats and how they want to, tackle it as it were. But what are your thoughts? Okay,
so the impact of NYSC allowance adjustment and the overall spending part of Nigeria is quite minimal. How many of them are engaged in that?
So you don't think that going forward there's going to be an increase in money supply generally in the system?
No, you see, if we have a slight increase in money supply, remember the state we are in, we have very high level of weak purchasing power in the country. People talk about electionary spending right from 1999 when we enter into democracy, and we've been having an election 2013, both pre and the election year. we can't see any empirical evidence that actually electionary spending drive inflation.
Really?
Yes,
so
I mean, we have the figures there.
Much ado about nothing, is that it?
Yeah, so I mean, other important factors such as food shocks, such as impact of devaluation of the currency, impact of deregulation of PMS, impact of imported inflation, have the things that actually drive our inflation in Nigeria, other than spending from increase in maintenance salary. It may have certain points to it, but not to the extent of taking it back to where we are coming from. So for me, going forward, when the federal government is talking about, and other governments are talking about, the increase in salary of civil servants, this is my personal opinion, not the opinion of FST.
So are you saying, or do you think that the MPC is just overreacting when they keep focusing so much on the inflationary trends? And what we hear now, I mean, still speculation that there's a possibility that the headline interest rate could actually be increased, just because of the inflationary threats that the MPC is anticipating.
Well, what they said in the last communique is the fact that if there is inflationary threat, they will increase rates. The central bank is there to ensure stability in prices, inflation, and exchange rate. Okay. But then if that do not happen, there is not going to be that. And I think that what we have at the moment is more of, we just have to give a trade-off. We think there is the need for policy stimulation to grow the economy, rather than focusing on really the inflation rate that may not even be impacted so much by monetary policy tools.
Okay, Ayodele, thank you so much for your time today. We appreciate you being on the show.
Thank you for having me.
Ayodele Akinyome, Head of Research at FSDH Merchant Bank. And